Let's take the conversation forward. Marc Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, is with us. Marc, great to have you join in. So first things first, are you expecting a rate cut from the Fed later tonight? And what does that mean for equity sentiment overall?
Yeah, good morning. It does seem to be the case the Fed will proceed with a second rate cut. That's priced in by markets, and so that's probably going to be considered as a non-event. It's really their forward guidance and the Q&A session that will be very important, because there are further rate cuts priced in, not just for the remainder of this year, but also next year. The other thing that market participants will be watching is the extent to which the Fed confirms they will be concluding their QT program and effectively normalizing balance sheet policy. That's also to some extent expected by the market. And so if the Fed does deliver on those two areas, then it's likely to be an uneventful central bank meeting. But of course, if there's any sense that the Fed is still hedging its bets, still somewhat concerned around its inflation mandate, that could create some volatility for markets across asset classes.
I don't know. It's not, I think, the base case at all for anyone. But given the lack of data, Fed's going blind, right, in the meeting. They only have this inflation print, but hardly any details on the labor market. If they decide to stay paused today, for whatever reason, absolute shocker for the market, how would that reaction play out? Would there be a substantial downside, or will the market look through it just because we're still in shutdown territory?
That's just not the base case that they will fail to move on rates. But of course, if we play that hypothetical game in the conversation, then you'll see some repricing out of rate cuts and potential pressure on the front end of bond markets, the bond curves. And that could potentially create some volatility in the more rate-sensitive parts of equity markets. But then the market will be looking through the rationale for that. If the Fed's saying we simply hadn't had enough data, we'll revisit it when the government shutdown concludes, the markets will, to some extent, try to look through that. But if there is a sense that the Fed is doing it for fundamental reasons, that its perception around the data is stabilization or inflation upside risks prevailing again, then that's more likely to have a persistent impact on market sentiment.
Marc, is the sentiment around precious metals turning a little bit?
We take the view that technically, particularly gold, but also silver, became a bit overstretched, overextended. There was a build-up, a re-acceleration of options trading around precious metals. And so this can be seen as effectively a cooling off and a return back towards trend lines, which still look quite positive on a strategic longer-term basis. So we're actually looking at the price action and having sort of locked in some gains at high levels earlier on to see what kind of levels we think represent a better re-entry point. But the drivers of why gold and other precious metals have performed very well over the last 1 to 2 years are still intact. A geopolitical outlook that's somewhat uncertain, bit fragmented, both fiscal and monetary policy that's skewing towards easing of financial conditions, no real credible plan by some of the major government debt issuers around fiscal retrenchment, and also some question marks remaining around the inflation outlook and the extent to which central banks are looking to diversify their US dollar denominated reserves away from paper towards gold and other physical commodities.
All right. Hi, Marc. Good morning and good to see you. And as always, what about global equity markets? I recall you telling us that you have a fair bit of exposure to Asia, India included as well. As of now, how are you approaching global markets? If you could tell us between, the emerging market basket, developed markets, and where does India fit in? We have argued in the past about valuation reset. Some part of that has happened. Your view on India?
Yeah, at a global level, we have to recognize that the equity markets have performed very strongly in the last few months. Some signs of the early stage of a bit of a melt up. And in that situation, what we're trying to do is participate in that move, but not apply additional capital freely and broadly across any parts of markets. We're starting to get a bit more selective with capital deployment. In an Asian context, we think that Singapore equity still looks strong. The MAS program to encourage deepening and broadening of local equity markets is a positive catalyst. We also recognize that India has seen some stabilization and some recent relative performance momentum. We remain neutral there, but we like it as a diversifier away from the more cyclical markets, such as Northern Asian markets, which have had a very strong cyclical move in the last few months, but perhaps might be at risk of profit taking, particularly in Korea as an example, where, again, from a technical point of view, the market does look stretched in the short term, even though there are reasons to be constructive and positive on a more medium-term basis as well.
Okay, all right, Marc, we'll leave it there. Thanks very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. Well,